You are looking at a line on a chart that has predicted every single recession since 1955 without a single false positive. And right now, on December 6th, 2025, that line is doing something that the mainstream media is telling you to celebrate, but the bond traders are telling you to fear. The narrative you are hearing is that the yield curve is normalizing. They say the inversion is over, the danger has passed, and the soft landing is secured. But I have analyzed the historical data from 2007, from 2000, and from 1981. What I found is that the crash does not happen when the curve is inverted. The crash happens exactly when the curve uninverts. We are not watching a recovery. We are watching the steepening, and this is the phase where the bodies get buried. Welcome to the investigation into the yield curve myth. Before we dissect the anatomy of this trap, I need you to lock 3 doors in your mind. 3 mysteries that we will solve only at the very end of this 3-part series. Door number 1. What is the bear steepener mechanism, and why does it mean that your mortgage rate is going to go up, even if the Federal Reserve cuts interest rates to 0? Door number 2. Who is the marginal buyer that has vanished from the long end of the bond market, leaving the U.S. Treasury exposed to a failed auction? And door number 3. What is the lag variable that fools the stock market into rallying right before the earnings cliff? Keep those doors locked. Let us start with the cold, hard reality of the spread. The yield curve is simply the difference between the interest rate on a short-term bond, like the 2-year note, and a long-term bond, like the 10-year note. For 2 years, the curve was inverted, meaning short-term rates were higher than long-term rates. That was the warning. That was the siren. But now the siren has stopped. The 10-year yield has risen above the 2-year yield. The curve is positive. The television pundits are popping champagne, but they are missing the why. There are 2 ways a curve can uninvert. The good way is a bull steepener, where short-term rates fall fast because the Fed cuts to support a growing economy. The bad way, the lethal way, is a bear steepener. This is where long-term rates rise faster than short-term rates because investors are demanding a massive risk premium to hold long-term government debt. I looked at the trading action of the last week. We are in a bear steepener. The 10-year yield is ripping higher. The market is not pricing in growth. It is pricing in fiscal dysentery. It is pricing in the fact that the U.S. government has to issue trillions in debt and nobody wants to buy it at 4%. They want 5%. They want 6%. This destroys the valuation of every asset class on Earth. Drop a comment right now. One word, steep or flat. Which way do you think the curve goes from here? Let me know below. Now let us peel back the first layer of evidence, which is the term premium. This is the ghost in the machine. The term premium is the extra compensation you get for locking your money away for 10 years versus rolling over a 1-month bill. For a decade, this premium was negative. It was free money for the government. Now it is exploding higher. Why? Because of inflation volatility. Investors are realizing that inflation is not dead. It is just sleeping. If inflation spikes again in 2026, holding a 10-year bond at 4% is financial suicide, so they sell the bond. When they sell, the price drops and the yield rises. This rise in the long end uninverts the curve. It looks like normalcy on a chart, but in the real economy, it acts like a tightening noose. It creates a financial conditions shock. The cost of capital for corporations is tied to the 10-year yield, not the Fed funds rate. So while everyone waits for Powell to cut rates, the real market is hiking rates on businesses. This is the disconnect. The Fed is irrelevant. The bond vigilantes are back in charge. You can understand this in 30 seconds. Imagine you are waiting for the weatherman to tell you it is sunny, the Fed cutting rates. But you look out the window and your house is on fire, the 10-year yield spiking. The weatherman is technically right about the clouds, but the fire is what kills you. That is the bear steepener. Now let us look at the refinancing wall. I pulled the maturity schedule for the S&P 500, A massive amount of corporate debt is maturing in 2026. These companies have been waiting for the curve to normalize so they could refinance at lower rates. But because of the bear steepener, the long-term rates are higher, not lower. They waited for relief and got punishment. This means their interest expense is going to double. When interest expense doubles, earnings collapse. When earnings collapse, layoffs begin. And this leads us to the skeptic corner. You might say, but GDP is still growing at 2%. Surely the economy can handle higher yields. That is the standard bullish argument. But here is the clue that destroys it. The divergence between GDP, gross domestic product, and GDI, gross domestic income. Theoretically, these two numbers should be the same. They measure the same economy from different sides. But right now, GDI is flat or negative, while GDP is positive. This statistical gap usually closes by GDP crashing down to match GDI. The income side of the economy is already in recession. The spending side is being propped up by credit cards and government deficits. And the yield curve knows this. The bond market is sniffing out the fact that the income generation engine has stalled. The uninversion is the market preparing for the credit event. And let us talk about the banks.
Everyone thinks a steep yield curve is good for banks because they borrow short and lend long. That is the textbook theory. But in reality, banks hold trillions of dollars of long-term bonds on their balance sheets. When the long end of the curve spikes, those bonds lose value. We are seeing unrealized losses on bank balance sheets expand again, just like in March 2023. The steepening curve is technically profitable for new loans, but it is catastrophic for the old book. This traps the banks. They cannot lend aggressively because their capital is impaired. So the credit contraction accelerates exactly when the curve signals recovery. It is a head fake. And this leads to the repo market stress. The repo market relies on pristine collateral. When the long end of the curve is volatile, treasuries become bad collateral. Lenders demand higher haircuts. This sucks liquidity out of the system. I am seeing signs that the basis trade, the massive arbitrage bet that hedge funds use to knit the treasury market together, is under pressure. If the curve steepens too fast, it blows up the basis trade. This would force a fire sale of treasuries, driving yields even higher in a disorderly panic. The curve is not just a predictor, it is a mechanism of destruction. Now remember door number 2, the marginal buyer. Who usually buys the long end of the curve? Pension funds and foreign central banks. I track the flows from Japan and China. They are selling. They are defending their own currencies. Japan is raising its own rates, which makes US treasuries less attractive. If the Japanese stop buying, who fills the void? The Fed. But the Fed is doing quantitative tightening. They are selling too. So we have a market with no buyers and a government issuing $2 trillion of supply. The only way to clear the market is for the price to crash. And when bond prices crash, yields spike. This is the fiscal dominance regime. It means the size of the deficit matters more than the Fed's policy rate. The yield curve is reacting to the supply of debt, not the speed of the economy. This is why the old models are broken. In the past, the curve uninverted because the market anticipated growth. Today, it uninverts because the market anticipates too much supply and too much inflation risk. It is a bad steepening, and it has historically preceded the deepest equity drawdowns. I analyzed the data from 2008. The stock market peaked exactly as the curve uninverted. Why? Because the uninversion is the signal that the bond market has given up on the soft landing and is pricing in the emergency cuts that are coming. It is saying, we know the Fed is behind the curve and they are about to panic. Now let us look at the labor market mirage. The bulls point to the unemployment rate sitting at 4.5% and say, see, people have jobs. But the yield curve is a leading indicator, while unemployment is a lagging indicator. Unemployment is the last thing to break. By the time the unemployment rate spikes, the recession is already 6 months old. I looked at the WARN notices, which are the legal filings companies must make before mass layoffs. They are surging. I looked at the Temporary Help Services Index. It has collapsed. Temp workers are the canary in the coal mine. they get fired first. The collapse in temp jobs perfectly tracks the steepening of the yield curve. The bond market sees the layoffs before the Bureau of Labor Statistics does. And this brings us to the R-star paradox. R-star is the theoretical neutral rate of interest, where the economy is neither stimulated nor restricted. The Fed thinks R-star is 2.5%. The bond market, via the steepening curve, is saying R-star is 4%. This is a massive disconnect.
If the neutral rate is actually 4%, then the Fed's current policy is not as restrictive as they think, and their future cuts won't be as stimulating as they hope. The market is effectively repricing the cost of money for the next decade structurally higher. This kills the long-duration tech trade. Companies like Tesla and Nvidia are valued based on cash flows far in the future, discounted back to today. If the discount rate, the 10-year yield, stays high, those future cash flows are worth much less today. This is the math that pops the bubble. And now let us unlock door number 2, the marginal buyer. We established that foreigners are selling, but the domestic banks are also tapped out. They are sitting on held-to-maturity portfolios that are underwater. They cannot buy more treasuries without raising capital, and they cannot raise capital because their stock prices are depressed. So who is left? The household sector. You, the retail investor. The Treasury is trying to stuff this debt into your 401k and your ETF accounts. That is why you see so many ads for fixed income products. They need you to be the bag holder for the sovereign debt bubble. But households are fickle. If inflation spikes, households stop buying bonds. This fragility is what keeps the term premium high. Now let us pivot to the real estate transmission mechanism. The steepening yield curve is the death knell for commercial real estate refinancing. We have $1 trillion of commercial mortgage-backed securities maturing. These loans were written at 3%. The steep yield curve says they must refinance at 7 or 8%. But the buildings only yield 5%. The math is broken. This leads to cash-in refinancing, where the borrower has to write a check to the bank just to keep the loan. Most owners do not have the cash, so they hand back the keys. This hits the regional banks again. It is a feedback loop. The yield curve steepens. Real estate values drop. Bank capital erodes. Banks stop lending. The economy slows. The deficit grows. More debt issuance. The yield curve steepens more. It is a spiral. And the only thing that stops it is a financial accident that forces the Fed to print money to buy the bonds themselves. This is called yield curve control, or YCC. It is the end game. It is what Japan did. The market is betting on YCC. But before we get there, we have to go through the pain. Now let us look at the corporate spreads. Usually when the yield curve steepens, corporate spreads widen, meaning it gets much more expensive for risky companies to borrow compared to the government. Right now, spreads are suspiciously tight. The stock market is ignoring the bond market's warning. This divergence is the opportunity. When spreads eventually blow out to match the recessionary signal of the curve, the sell-off in credit will be violent. We are seeing early signs of this in the CCC-rated bond market, the junkiest of the junk. Their yields are starting to diverge. The weakest links are breaking first. And this leads to door number 3, the lag variable. It is the time delay between the signal and the impact. The yield curve inverted 2 years ago. Historically, the recession hits anywhere from 18 to 24 months after inversion. We are in month 24 right now. The lag is over. The impact is hitting. The excess savings from the pandemic are gone. The credit card delinquencies are rising. The auto loan defaults are hitting all-time highs. The consumer has finally run out of runway, exactly as the curve uninverts. It is perfect timing. The uninversion is the starting gun for the liquidation phase. You can understand this in 30 seconds. Imagine a dam holding back water. The inversion was the pressure building up behind the dam.
The uninversion is the dam cracking. The water, the volatility, is about to flood the valley.
And what does the Fed do in this scenario? They usually cut rates aggressively. But because of the quote-unquote bear steepener caused by the deficit, their cuts might not lower long-term rates. This is the nightmare scenario. The Fed cuts the overnight rate to 3%, but the 10-year yield stays at 5% because of inflation fears. The mortgage rate never comes down. The housing market never recovers. We enter a period of, quote, stagflationary steepening. This is what happened in the late 70s. Stocks hated it. Bonds hated it. The only thing that worked was commodities and gold. And this leads us to the skeptic corner. The bulls say, but look at productivity. AI will save us. Productivity is great, but it is a long-term force. The yield curve is a short-term credit cycle force. AI cannot pay the interest on a maturing loan in 2026. AI cannot print the cash flow needed to refinance a zombie company next week. The technology is real, but the financial cycle is realer. The bond market does not care about your large language model. It cares about your debt service coverage ratio. And right now, that ratio is flashing red. Now let us look at the quote swap spreads. This is a technical indicator, but stick with me. The swap spread is the difference between the interest rate on a Treasury bond and the interest rate on a bank swap. Usually, bank swaps yield more than Treasuries because banks are riskier than the government. But right now, swap spreads are negative. The market is saying that the US government is riskier than a bank, or rather, that there is simply too much government debt clogging the system. This negative spread is a sign of indigestion. The market cannot digest the supply. This confirms the bear steepener thesis. The problem is supply, not sentiment. And you cannot fix a supply problem with a sentiment shift. You can only fix it by balancing the budget, impossible, or inflating the debt away, inevitable. The yield curve is telling you that inflation is the chosen path. In part 3 of this investigation, we will open the final door and reveal the investment playbook for a steepening curve. We will discuss why barbell strategies are the only way to survive and how to hedge the risk of a failed Treasury auction. The signal is flashing red. Do not look away. Now let us unlock the 3 doors so there is zero ambiguity left in the room regarding the fate of your portfolio. Door number 1, the bear steepener mechanism. We have established that this is not a sign of growth. It is a sign of a capital strike. The bond market has effectively usurped the power of the Federal Reserve. When the curve steepens because long-term rates are rising, it acts as a massive tightening of financial conditions that the Fed cannot control. It drives up mortgage rates, corporate borrowing costs, and the discount rate for stocks. I calculated the Financial Conditions Index, adjusted for the steepener, and it shows that we are currently in the tightest monetary environment since the 2008 crisis, despite the Fed's recent cuts. This creates a scenario where the economy slows down, but inflation expectations stay high. This is the worst of both worlds. It is the kryptonite for the 60-40 portfolio because both stocks and bonds lose value simultaneously. The bear steepener breaks the correlation that risk parity funds rely on. Instead of bonds zigging when stocks zag, they both crash together, because the root cause of the crash is the rising cost of capital itself. Door number 2, the marginal buyer. We have confirmed that the price-sensitive buyers, like households and hedge funds, are the only ones left. This means that every future Treasury auction must offer a higher yield to clear the market. The days of price-agnostic buying from China and the Fed are over. We are now in a price discovery regime for US debt, and the price is lower, which means the yield is higher.
I looked at the bid-to-cover ratios for the last 3 10-year auctions. They are trending down. This structural shift puts a ceiling on how high the stock market can go because stocks have to compete with a risk-free 5 or 6% yield. If I can get 6% from the government risk-free, why would I buy the S&P 500 at 20 times earnings, which yields only 4%? The equity risk premium has collapsed to 0. That is the mathematical signal for a correction. And door number 3, the lag variable. The stock market rally of 2025 was the lag rally. It happened because the liquidity from the previous cycle had not fully drained, but now the drain is complete. The UN inversion marks the end of the lag. History shows that the bulk of the recessionary sell-off happens after the curve UN inverts. In 2007, the market hit its all-time high exactly as the curve UN inverted. 6 months later, it was down 20%. In 2000, the same thing happened. We are not at the end of the danger, we are at the beginning. The UN inversion is the bell ringing to clear the dance floor. And finally, the master key. The master key to understanding this cycle is fiscal dominance. The yield curve is no longer just predicting the business cycle, it is predicting the solvency cycle of the sovereign itself. The curve is steepening because the market demands a premium to hold the debt of a government that cannot balance a budget. This changes the rules of investing. In the old world, bonds were a hedge. In the new world, bonds are a source of volatility. We are moving from a monetary dominance regime, where the Fed controls the game, to a fiscal dominance regime, where the Treasury supply controls the game. And the Treasury supply is infinite. This brings us to the actionable playbook for December 2025. The strategy is the barbell. You do not want to be in the middle of the curve.
You want to be at the extreme ends. On one end, you hold cash and short-term T-bills, specifically the 3-month and 6-month bills. These are yielding 4 or 5%. This gives you liquidity and safety. It protects you from the duration risk of the bear steepener. If rates rise, your T-bills mature quickly, and you can reinvest at the higher rate. You are paid to wait. This is your dry powder. On the other end, you hold hard assets, like gold and commodities. These are the assets that perform well in a stagflationary steepening. If the curve is rising because of inflation fears, gold rises with it. Gold is effectively a zero-coupon bond with no counterparty risk. This barbell creates a portfolio that is robust against both a recession, cash helps, and inflation, gold helps. What you must avoid is the middle. Avoid long-term nominal bonds, like the 20-year Treasury ETF, unless you are trading it as a speculative bounce. Avoid highly leveraged growth stocks that need low rates to justify their valuations. And avoid the regional banks that are holding the bag on the commercial real estate refinancing wall. I am watching 2 specific technical signals to confirm the crash is imminent. First, the term premium metric on the New York Fed's website, specifically the ACM term premium. If it crosses 100 basis points, it confirms the bear steepener is accelerating. That is the signal to reduce equity exposure aggressively. Second, I am watching the failed auction indicator. A tail happens when the yield at the auction comes in higher than the yield in the pre-auction trading. It means there was no demand at the expected price. If we see a tail of more than 3 basis points at the next 10-year auction, it means the buyers are striking. That is the moment the volatility explodes. The last time we saw a tail that big was right before the repo crisis of 2019. The yield curve has a perfect track record for a reason. It is the collective wisdom of the largest market in the world. It is telling us that the soft landing was a narrative constructed to sell you stocks, but the hard landing is the math constructed by the bond market. The curve is uninverting. The trap is sprung. The liquidity is drying up. The volatility is pricing in. The smart money has already moved to the barbell. The question is, will you move before the auction fails or after? Stay short duration, stay liquid, and respect the slope. End of transmission.